I'd type that into my computer, buy 100,000, $291, enter, it would go out, and I would buy 100,000 shares of AMD at $2.91. But in 2007, when I would try to do exactly that same thing, I'd only get 80,000 of the 100 that I saw. And in 2008, I would try to buy 100, and I'd get 70,000 of what I saw. In 2009, I tried to buy 100,000. I get 45,000 of the 100,000 shares that I saw, and it drove me insane. I do what every trader does when they think their computer's not working. I'd call tech support, and the guy would run out of the back and say, "What's going on?" I'd say, "Watch this. I see 50,000 shares at $2.93. I'm going to try to buy that. I will only get a fraction of what you and I see on the screen." And I try to do it, and I get 15,000 shares. And I say, "What do you think is happening?" And he says, "Well, I think that there's more people that want to buy AMD, and it's not just you, meaning that you're part of a market that's moving very quickly and many people want to trade." And I said, "Okay, well, I'll prove you wrong." I say, I'm going to try to buy 45,000 shares at $2.95, but I'm not going to press this button for 5 seconds. And if while I'm counting the stocks trading, you're right, other people want to buy AMD. I said, but nothing's going to happen until I press this button. So I'd count to 5 or 7 or whatever. I could change it, doesn't matter. And then I'd hit the button, and that's when the stock would move. That's when the offers would disappear. And I'd say to them, I said, I'm the event. This is not a random occurrence. The only reason people want to buy AMD is because I want to buy it. I had no idea why this was happening. It went on for 2 years. Right? Michael Lewis, I think some people, if they haven't read the book, kind of would view me as a disruptor, and that's like the opposite of what I am. I spent my entire life getting along with people. This is not, in a million years, I never thought I'd be in the position I'm in right now. This went on for 2 years. Myself, my traders, we just dealt with it. It became common knowledge that if I saw 500,000 shares of a stock on the offer, that I would only get a fraction of what I actually saw. I got really lucky. In 2009, RBC offered me an opportunity to run what's called electronic sales and trading. And what that meant, in a nutshell, is I went from managing a group of people, human traders, to computer programmers and network engineers that were building algorithms that our traders would use. So I went from managing traders to managing people who built programs and algorithms for those traders. I actually didn't want the job. So my first answer to them offering me this job was actually no. And it's funny, because life is a lot about decisions and a lot about luck. And for some reason, my boss kept persisting. I think you should really take a look at this job. I didn't want to do it. Actually, funny story is that we had bought a company, terrible company. We bought it in 2007. They were supplying the technology that we were using, and I actually thought they were partially responsible for the fact that I couldn't trade. We buy this company, it's a pile of garbage, and I can't trade. They fired the CEO, and they wanted me to take that company over, and I just didn't want to do it. I went out, and I said, okay, I'll do a little bit of due diligence to see if I want to take this job. And I went out and I sat with a friend of mine who actually worked at SAC Capital in Stamford, Connecticut, Steve Cohen's fund. And I said, if anyone has the best tools, algorithms in the market, it's SAC Capital. So I sat with a trader from SAC. He was using algorithms from Goldman Sachs and Credit Suisse and Morgan Stanley, et cetera, et cetera. He could not buy or sell what he saw on his screens either. And that was the first time where the light bulb went off in my head to say, this isn't an RBC problem. It's not a crappy technology problem. One of the biggest hedge funds in the world is using tools built by all of the largest banks, and he can't buy or sell what he sees on his screen either. At that point in time, I actually knew the problem was systemic. So I took the job because I really wanted to figure out what was happening. And it turns out that some of the people that again, life has a lot to do with luck. I was hiring people in the spring of 2009. That's when I took the job. And if you look at a chart of the S&P, the absolute bottom of that chart is spring of 2009. And all of a sudden, I could convince a bunch of people who never in their wildest dreams ever wanted to work for the Royal Bank of Canada, that the Royal Bank of Canada was actually a pretty good place for people to work. So I built a team at RBC. For the first time also, I started to read about high-frequency trading. I had no idea what that was, but I knew that it sounded pretty important, and I needed to hire people from that industry, and I did. And what some of the people from the high-frequency trading industry explained to me was that the 100,000 shares of AMD that I saw on my screen wasn't just at one stock market, the New York Stock Exchange or NASDAQ. There were actually at the time 13 different stock exchanges in the United States that were geographically located in different buildings. Now the geography actually is important here because what that means is that when I see 100,000 shares on my screen and I try to enter an order, me pressing the button once isn't just one action. Me pressing the button once sends one message to something called a smart order router. It splits my order up into as many as 13 different messages and blasts them out to the stock exchange. This is going to sound crazy, but RBC at the time, we were located in downtown Manhattan. All the exchanges were in New Jersey, which is west of Manhattan. So what that means is that my one order to buy 100,000 shares of AMD, let's say there's 25,000 shares offered at 4 exchanges, BATS, Direct Edge, NASDAQ, and New York Stock Exchange, the 4 biggest exchanges at the time. I would blast 4 orders out to the market from RBC, and they would arrive in sequence first at BATS, because BATS is located in Weehawken, New Jersey, right on the other side of the Lincoln Tunnel. It's closest to Manhattan. Then Direct Edge and Secaucus, then NASDAQ and Carteret, and the New York Stock Exchange built a new, I heard, they spent close to $1 billion building a data center in Mahwah, New Jersey, and one in Basildon. It would arrive there last. It was 60 miles away from NASDAQ. The difference in time, this is going to sound completely bananas, but was 2 milliseconds between arriving at the first and the last exchange. At the time, I thought that was actually pretty fast. It's 300 milliseconds to blink your eye. 2 milliseconds to me seemed pretty fast, except for the fact that one of the people I hired, this guy by the name of Ronan Ryan, had just come from building out high-frequency trading infrastructure for some of the biggest high-frequency trading firms there were. And he said, I got bad news for you, Brad. I can get from one building, BATS, to the next in 476 microseconds. A microsecond is 1/1,000,000th of a second. He could actually get there 4 times faster than I could, which meant that as my orders were going out to the market, we would arrive at BATS first. Ronan's clients would pick up a signal and race us to Direct Edge, NASDAQ, and New York. And they were doing 2 things. One is they were canceling their sell orders. Now that they know a buyer has come in and bought everything, all of the AMD shares at $291 on BATS, they're racing out to cancel any sell orders they have in the market. But second, they're also trying to buy shares ahead of me to sell back to me at a higher price. And this is what was happening. After Ronan explained this to me, I said to him, well, can we get faster? And he said, well, we're the Royal Bank of Canada. We will never be faster than anybody, right? So getting faster was not a solution. There were things that his clients were doing that we would never do. A funny story is that also proximity, where you're located in the data center. So now that I've paid to be in the data center, where you are in the data center matters. And he said that next to one of the big stock exchanges, Toys R Us actually owned a cabinet next to one of the big stock exchanges by accident. They were there. I think they were probably running their website or something like that from there. And he said he was working on behalf of clients trying to pay Toys R Us insane amounts of money, and they finally gave in. They finally sold their space, and they wanted to leave Toys R Us as the identifier on the cage because they didn't want anyone to know who was in the cage. Proximity matters, and they spent a ton of money on that. He said we cannot be faster than them. But the one thing we could do was get slower. And at the time in 2009, this sounds crazy. Every big bank out there was selling to their clients. We're the fastest, we're this, we're that, we're microsecond, we're nanosecond. And we said, you know what, we're going to get slower. And what that means is slow down our fastest connections to try to get all orders to arrive at all exchanges as close to simultaneous as possible. And in theory, the way to think about this is send the order to New York Stock Exchange first, send the order to BATS last, to arrive simultaneous, and we actually were able to do that. We got our arrival variance down to 290 microseconds. It is not as easy as this diagram makes it look. It was actually very, very hard to do because latency changes. At the beginning and end of the day, there are more messages on the network because of the open and the close. Latency fluctuates. So this was actually something where we had to use messages in a real-time basis to calculate variances between exchanges, but we got our variance down to 290 microseconds, which meant I could now buy or sell everything I saw on my screen.